All right, so I think you have got the real meaning of these matters. You have seen the word in.
If you can just say yes in impairment, I've understood yes the depreciation. Actually, I thought like maybe it's the way the asset depreciates, but now I've understood that it's to try to allocate like the assets from an item, and since they cannot put it at once in the profit and loss account, then they
Yes,
do it like yearly.
yes,
So if you can explain again
impairment.
the impairment, yes.
Okay, no worries. I'm just doing this. You know why? I'm doing this because if I do this, and when you reach to this standard called impairment, you will actually have nothing to start. Then you'll say, "Oh, so I did well." No problem. No problem.
Okay,
Yes.
okay,
You better do it now so that when you reach there, we'll just be blazing. You know, there are some standards which will just be passing through.
okay.
Yes, we can do this. As for impairment, this is what I'm trying to say now. Let's say in your books, in the statement of financial position, right? And the non-current assets, you go and say that, okay, I have my item of PPE at $40 million, right?
Yes,
That is what we call the carrying what? Carrying
the
amount.
carrying amount.
Okay, now, this standard of impairment just tries to help you that it takes care of the fact that you may accidentally hold the asset at a much higher value than what it can generate, right? You know, it's very wrong. You say that in the books, I have an item of $40 million, while when you actually try to get some money from that, you can only get $30 million. That's wrong. It means that you have only recorded it at 40, right?
Yes,
Yes.
overstated.
So that's why when you do study IAS 16 impairment laws, it says IAS 16 what? Impairment. It is the standard, IAS 36, sorry. Right.
The six.
Yes.
Yes.
You would find that they compare carrying amount against recoverable what? Amount. You know, when you talk
What's, sorry, not to cut
recoverable,
you, what's this recoverable amount?
recoverable amount is what, you know, when you have an asset with you, it means that an asset is a resource. It's an economic resource, right?
Yes.
It means it can generate income for you. Am I wrong? It can generate economic benefits for you. Am I wrong?
No, you're not wrong.
Yes. If I'm not wrong, then there are ways to generate. We go back to our two definitions. That's why I told you. If you need to generate and you have an asset, it's either you use it so that you get the value in what? In use, right? Or you say,
Okay.
oh, I don't want to use this, I need to sell it outright. So you have your fair what?
Fair value.
You get the point now. So you need to be able to connect the
Yes.
things, right?
Okay.
So now
Okay.
it will be up to you now. You choose. Okay, let's say if I say that I will use it for the first year, second year, third year, fourth year, and then I discounted values to the present value, let's say I would be having 30 million, right?
Yes.
But then someone tells you if you record it at fair value, maybe you'd have 32 million. If you sell it right now, you get 32. And actually, you know, when you say that you are
Yes.
selling something, you'll have to incur some costs, right?
Yes.
It won't be
Okay.
for free. That's why you usually say fair value less cost to what? I'm just adding something. Less cost to sell. CPE.
Sales
Cost what? To
less
sell.
cost. Sales.
Yes.
Yes.
So is actually someone. Hello?
Yes, I can hear
Is
you.
is someone who is rational. Which decision would you take between these two? 30 or 32?
This fair value is how much are
32.
the costs?
Presume they are zero. Just presume they are zero.
Okay, I would prefer to get the fair value amount 32.
Yes, now you get the point. Now, if you go and
Yes,
read what A36 tells you, it tells you here, it's like a rule, but it's not actually a rule. It's just you need to understand, right? They
yes,
tell you the higher of value news and fair value, which is obvious, even if they don't tell you the higher, right? You have an option to either use it to get 30 or to sell it to get 32. You'd obviously sell it, right? If you are rational.
yes,
Yes. So
yes.
in the standard, they will tell you take the higher of value news and the fair value less cost what? To sell. So you'd
Okay.
obviously take this one,
Okay.
right? Now, so you compare
Yes,
these two and you take the higher. So you'd say, okay, now I'm going to compare 40 against what? 32, the higher, right?
32.
And then you say, okay,
Okay.
am I doing this
Okay.
right or not? In the books, I've recorded something at 40, but oh Lord, I can only recover 32 from it. Then am I doing the right thing to record it at 40?
No,
No, I'm
you're
cheating the
overstating.
stakeholders, right? Yes, I'm cheating the
Yes.
stakeholders. Stakeholders could get a wrong impression about the company, right? Due to the wrong what? Financial reporting.
The wrong
Say,
value.
oh,
Yes.
there is an impairment loss here. 40 minus how much? 32, which is 8. So you say that, oh, so I have this problem. So to be fair and square, I need to reduce my carrying amount by 8, right?
Yes.
So you'd reduce it from 40 to how much? To 8.
32.
Yes, to 32. As for the double entries, since you're not doing impairment here, I won't speak of it now, right? I don't know how to distract you from I-16, but this is what we are going to do. Okay, now presume maybe this was, let's say it was 50 here, right? If this was 50, then between 50 and 32, you'd obviously take 50, right?
Yes.
So I would compare 40 against what? 50.
50.
Now, 40 against 50 would say, okay, I've recorded something at 40, but actually I can recover 50. Then you do not say there is impairment here, no impairment, right? Because I've recorded it at 40 in the books, but I can fetch 50, right? No worries.
Okay.
Impairment just avoids recording something at an amount that you cannot recover, right?
Okay.
Yes.
Okay.
Yeah, in the
It's
books I have
okay.
40, but I could recover 50. I say, okay, no problem, no problem. I won't have this time to start arguing with you. Just remain with your 40. I proceed with my own matters, and then life goes on, right? So here I would say, no
Okay.
what? So impairment loss is just not make the mere difference, right?
Okay.
It is the fact
Okay.
that the carrying amount exceeds what you can recover from using either using the asset or selling it, right?
Yes. Okay.
So
Okay.
that's why when you go further and look at something. Initially, I told you that this standard does not apply to IFRS 5, non-current assets held for sale, right?
Yes.
When you go there now, that's why I need you to understand this well. When you go there, when you're told something is called non-current assets held for sale, it means when you do compare it here, right? We won't have something called value news, right? Because when you
Yes.
call something value news is something used for the first year, for the second year, for the third year. It means you expect to use it for many years, right? But you call that one
Yes.
asset held for sale. So automatically, no one will tell you about this. It should be your own observation, but you would find that they only concentrate on fair value less cost one to sell. Because as for fair
So
value, we don't care for how much longer you're going to stay with the what? With the asset, right?
we can see.
So you would see
Okay.
that automatically. That's why I'm telling you the standards have some kind of a connection, right?
Yes.
Okay, so I hope that is fine. And when you are at 36, I hope you would see that. I think when I'm trying to speak of
Yes.
something like this, I'll be trying to share those so that maybe when you get some time, they are saying that you have to take the soup when it is still hot, right?
Yes.
Yes. If you do that, maybe you say, okay, we spoke of that at 6, although I've not done it well. Okay, let me just go and peruse and see what I can see. So,
Okay.
so you may find some valuable things. Okay, now you're just dealing with the definitions. All this impairment and depreciation. You know why you are doing it? Because we started about the carrying amount. And we said the carrying amount
Yes.
is the cost less accumulated depreciation and impairment what? Loss. That is what
Yes.
has taken us all the way here. Depreciation
Okay.
and what? Impairment. You can just see they are normal words,
Impairment
but
loss.
there is a huge meaning behind them, like you have seen.
Yes. Yes.
Yes.
Yes.
Okay, now we are at recognition. And when you do see things like this, do not be surprised. I told you when you have an asset, the aim is to put it into the statement of financial position, right?
Yes.
Putting it into the statement of financial position means that's what we call recognition. Recognition is this process of incorporation of an item, right?
Yes.
For example, here in this case, since you're dealing with assets, is a non-current what? Asset. So
Asset.
you cannot just go to the statement of financial position and say, okay, PPE, without writing the amount, right, to record it. It will be nonsense now, right? You just say, okay, the stakeholder comes to the your financial statement, he sees their PPE, no amount. Then they will just tell you, so what are you giving me? What are you providing me with, right?
Yes.
So automatically after recognition, you expect to see something called measurement. You see measurement down here. Measurement. Because if you cannot
Yes.
measure something, then you have no right to recognize it. Because you cannot recognize something without knowing its amount. Something natural, you can just see that. So this is what we call recognition. And now there is the criteria for recognizing an asset, right?
Yes.
There are two conditions for recognizing an what? An asset, right? Oh, and these ones are common. You get them here, you would find the same for investment property as 40, right? So, did I give you some time? Can you proceed? Okay, so,
Yes.
okay, now you have an asset. You know,
Yes.
when you have an asset, you cannot say you have an asset if it cannot generate any benefits to you. So that's the first condition, is the first and obvious condition, right? You have an asset, you expect
Yes.
some benefits from it. That's why we say, first of all, it is probable that future economic benefits associated with the asset will flow to the what? To the entity. If you have an
Entity.
asset and you do not expect any benefit, then you do not have any right to recognize it in the books, right?
Okay. Yes.
Now I'm explaining this, but I'll still go back there and show you that these things you can also prove them mathematically. So
Okay.
first of all, it should be probable. You know, probable is actually it's more likely than not. That's the meaning of probable. More likely than what? Than not. If you're speaking of the percentages, then it's more than 50%, right? Speaking in just
Okay.
normal or in an ordinary way. But the other thing
Okay.
now is I told you, okay, I know that, I definitely know that, okay, I have a vehicle, I'm going to use it to transport the passengers, they would pay me, so I'm definitely going to get some economic benefits. I have every right to put it in my books, but at what amount now? Okay, you are told, okay, it's fine, put it. It's fine, put it. Now recognize at what amount. Then you start saying, okay, I'm not ready for this. I still not know this. Then they will tell you, okay, then you have no right to put it there, right? Remove it. That's why the second point should be
Yes.
the cost of an asset to the entity can be measured what? Reliably.
Measurable.
Yes, yeah, something like that. So you can know that, okay, I know the asset will give me some benefits, but also the cost can be measured reliably. If you are told it is probable there will be some future economic benefits, it means if you have an asset, right, it means you expect to use it. Let's say we spoke of value in use, right? You can generate
Yes.
maybe the cash flows in year one, in year two, in year what. You expect to get these cash flows. If you expect nothing, then you cannot recognize it. Why? Let me tell you, why can't you recognize it? Let's say you bought an asset at 40, just like before, right?
Yes.
But you find out that you do not expect any cash flows in the future. You expect zero, zero again, zero again, right?
Yes.
If you expect nothing, then actually you cannot say that it is an asset, right? Because as for the recoverable amount, you will have the value in use of zero and maybe the amount at which you can sell that asset, right?
Yes.
So it would be meaningless to record it in the books. So these two common conditions, you would find them for a lot of non-current what assets because they are just the normal principles. If you have an asset,
Okay.
there should be economic benefits expected. If you have an asset, of course, you should be able to measure it reliably because if you can't, then at what amount are you going to measure it, right? Yeah, so
Thank
it's just something like that. Or this one, I just added it here, but it's just a normal explanation. Let's just go through it, no worries. We speak
Okay.
of separate what? Separate items. We say
Okay.
most of time assets will be identified individual, of course, most of times, but you know, even the conceptual framework specifies that for sta- for very little assets, right? Like actually, it
Yes.
gives this example. Let's say the tools, the dies, or the molds, which are sometimes classified as inventory and written off as an expense. We mean that if you know accounting is done on the condition of materiality, right? If something is not material, if it's not big enough, if it is not impactful enough on the economic deficiency, if it does not have a significant impact on the economic deficiency of use of main users of financial statements, we say that it is not material, right? So even if you have something, you know that it is an asset, but it is of a very little value, the company may well decide to expense it. Instead of putting it as an asset in the statement of financial position, they put it as an expense in the income statement, and the asset disappears once and for all, right?
Okay.
And now for some assets, instead of expensing them to the income statement as an expense instead of an asset, they combine them together so that they have an appreciable amount, kind of a value that we can say, okay, this value is somehow fine, it somehow surpasses our materiality level, then let's well recognize it in the what? In the books. That's what they're trying to explain, right?
Okay.
Yes. So say major components, so or that's why it's no big deal. They're just trying to give a certain picture. So major components, let's say, or spare parts, however, should be recognized is property, plant, and what? And equipment. And maybe they're saying here for large and specialized items, and apparently single asset should be what? Broken down into its composite parts. They're just trying to give an example. The common example here is usually the aeroplane, right? Or
Okay.
maybe they like to use this with aircraft, aeroplane. It's just the same thing, right? You know, in an aeroplane, they say that you may find that maybe an aeroplane has two different components. We have the outer part, but also you have the inner part. Now, it is usually common that the inner part is usually replaced more often than the outer part, than the outer part.
Okay.
So you may have an aeroplane like this, right? You have an outer part, and let's say you have an inner part.
Enough.
An inner part can only stay for 4 years, but let's say an outer part is more durable and it could stay, let's say, for 12 years. So what happens here? Remember, the outer part has its cost and the inner part has its cost, right? So
Yes.
what we do, we separate their cost. The inner cost has the inner component has its separate cost, just like the outer, and you depreciate them differently, right? Because each one has different
Okay.
economic lives, right? This is what they're trying to speak.
Okay.
So when maybe it's time for this inner part, you can either replace it, you remove that cost of it, you recognize the new cost and life goes on. This is what they're just trying to what? To explain, right? So if you got my
Okay.
point here, on this category of separate items, they are trying to speak of what to do when you have some items mingling, right? If they
Okay.
are very little items, you may decide to put them with inventory, or you may expense them to the income statement. If they are huge items, you treat them separately. Just like for the airplane here, right? An airplane, let's say an aircraft is huge, but if you can have items of actually significantly high value, right? But they have different useful lives, you can treat them separately and then add their costs and the carrying amount, right? To arrive at the actual carrying amount.
Okay.
Yeah, so they're just trying to stress that. And I don't want to tire you a lot today. Today I'm just trying to you have to get there is no actually you just need to have this overview of what to expect in many standards, right? So
Yes. Yes. Makes
so no
sense.
worries, okay. So
Okay.
if you go to measurement now, like I told you, okay, you have said okay, my asset meets the condition of recognition very well. Okay, now at what amount am I going to recognize it? That's what I told you. It means you need to know its worth. So we go to what? To measurement, right?
Okay.
And for measurement, you would have two ways. You have initial measurement and then subsequent what? Measurement. Initial measurement is what we usually call cost. We call it what? Cost.
Yes.
So understand, it could be cost or sometimes we call it deemed cost. You would
Did
understand
you what?
why you call it deemed cost. DEEMED, deemed cost. It means that you would find out that there are some situations where you do not incur a cost to acquire something. For example, maybe you may exchange. Have you ever heard that? I have one asset,
Okay.
I have a
Yes.
vehicle, you have a machine, we exchange. If we exchange,
Yes.
I've not paid anything. So when I do exchange, there are conditions you might find that maybe I'm going to recognize my asset at your at the fair value, at my fair value, right? At the beginning. So since it's like I'm restarting, right? That
Yes.
issue, I may use the fair value, but I would call it deemed the cost, right?
Okay. Okay.
Why am I going to call it deemed the cost? Because you can see here, you see the definition of carrying amount. We said it's the amount at which an asset is recognized here, and we
Yes.
said that amount is recognized at which an asset is what? Recognized less depreciation and impairment. So that amount at which an asset is recognized, we call it cost or deemed what? Or
Cost.
deemed cost. Yes, that's what we call it. So
Okay.
you should expect that. That's why they tell you initial measurement here, but then we would see something called subsequent what? Measurement. For subsequent,
Measurement.
there is where you will see depreciation and what? And the impairment loss, right? Because depreciation and impairment are usually after some time.
Okay.
So initially, and now for most questions, you would be provided with the cost already. So you just have to start from this. They will tell you, okay, someone bought an item at a cost of this much, but that is not necessary. Sometimes you may have to construct the asset yourself, right?
Okay.
Yes. So that we are trying to complicate matters here and presume that you did not buy an asset outright and it was ready for use right away. No, you had to make that asset by yourself. That's why on this
Okay.
initial measurement, we'll look at all possible possibilities you could ever encounter, right?
Okay.
And that's why you see here that they tell, okay, initial measurement once an item once an item qualifies for recognition, as I told you that it has already met those
Yes.
two criteria for recognition. Now you need to know at what amount to measure it, right?
Okay.
Okay. Now this is what you look at these components of what? Of course. Let me ask
Okay.
one thing. You told me that you ever studied management accounting, right?
Yes.
Well, management accounting, whenever we speak of a product, we usually have three main components, right? We
Yes.
have direct what? Materials,
Cost.
direct cost.
Yes.
I'm breaking it
Labor.
and overheads, right?
Yes.
Now, okay, when we do see these things now, these are what make up products. Even where you are right now, if you look at something that has been made, right? Ask yourself,
Yes.
you see the material, right? Let's say that right now,
Yes.
maybe your laptop is on the table. That table is made of material, it's made of timber, let's say, or maybe iron, I
Yes.
don't know, right? That's material. Direct labor,
Yes.
the way it is molded into that shape show that someone's craft work there, right? So obviously
Yes.
there's direct labor there. But also, the way you see it is not like just materials and labor. There was kind of supervision, right? A lot of costs that played a supportive role, that played a secondary role, were incurred to make sure that maybe that desk you are using is at that condition. That's why we speak of
Okay.
materials, labor, and what? Overheads.
Direct.
So when speaking of component of cost here, you also do not need to memorize. You can obviously see. Look, they're saying purchase price less any trade discount or rebate. You're going to purchase materials to make something, right?
Yes.
Let's say you need to make a vehicle, you need the material. Obviously, purchase price less any trade discount or rebate. Do you know the difference between trade discount and cash discount?
Yes.
What is the difference?
A cash discount
Hmm.
is a discount that is given to a customer when they are buying an item and pay at the same time.
Hmm.
And the trade discount is when a customer has been given a period to make a payment
Hmm.
and they pay before that period that was agreeable.
Oh, I do not agree with that. You have tried,
Okay.
that's good, but actually there is some issues, right?
Okay.
Simply speaking, maybe of course this is not so clear, but maybe I should tell you so that we can well distinguish it, right? When we say
Okay.
trade discount happens, right? Hello?
Yes, I can hear you.
When we speak of trade discount, this is done actually when someone buys goods, let's say in bulk quantities. Okay, you're buying a lot of
Okay.
items. Okay, that's why you're buying a lot of items. It is just done to attract customers to buy. You attract them to do what?
Okay.
To buy
To buy.
at the first glance. That's why you may go to the shop and see that okay, the price is $100, but you see that they have cancelled it and they have written 80 what? Dollars. It means $100 is just the list price. It's not the actual price. The actual price is
Okay.
80. But when we speak of the cash discount now, it's okay. You someone tells you that okay, the price is 80, but if you pay me in 30 days,
Okay.
you would pay 10% less.
Okay.
Yes,
Okay.
you'd say 10% what?
Okay.
Less. But trade discount, they
Less.
just try to attract you. Actually, since you are their big customer, so they're trying to keep you, they're trying to hold you, right?
Okay.
That's why
Okay.
trade discounts you can never find trade discount in the books. Have you ever heard of something called trade what? Discount allowed and discount received.
Yes. I've heard.
What are they? Are they trade discounts or cash discounts?
Um,
They are all cash what? Discount.
yes,
Whenever you see a discount written in the books, that is obviously a cash what?
yes,
Discount. Yes, trade discounts should never appear in the what? In the books. That's why they tell you purchase price less, trade discount. We do not want to see it at all, right? And this purchase
okay.
price is usually called a list what? List price. It's just listed there, but it has nothing to do with what? The reality. That's why you won't have even paid it. You would obviously pay less
Okay.
trade what? Discount, right?
Discount.
Yes. That's number one. Okay. At that point, we have spoken of material. You need to know I've spoken of what. That's the point. You need to know what you already have in your mind to proceed. Then import duties and non-refundable purchase taxes. Now here we presume that you have bought something outside the country, right? You have
Yes.
bought something from overseas. So, each country, I think each country has the port, right?
Yes.
Usually the port authority. So when the goods are taken and they reach the port, there are usually taxes to be paid. Now, if such taxes are non-refundable, it means you have actually paid for that, right? An asset costs $30
Yes.
million. Dollars. I've been told to pay 10 extra dollars, and they are not refunding me with it. It means it's just part of an asset. Very obvious, right?
Yes.
Yes. That's import duties and other non-refundable. As long as the tax is non-refundable, it means it should be actually increasing to the cost of the what? Of the asset. And then you are told directly attributable cost of bringing the asset to working condition, right? These
Yes.
two are obvious. You're just saying directly attributable, I think, but it's obvious. Presume that you have gone to the port. Okay, you have bought something, let's say from China. It has come. You have paid for import duties, which is part B. Okay, from China, maybe you bought the items at this purchase price. At the port,
Yes.
you pay the import duties, and then you have to take it from the port to your point of installation, right? Say, right?
Yes.
Obviously. So, let's say you could maybe hire a vehicle, right, to take it there. That includes the direct attributable cost of bringing the asset to working condition. But if you take it from one point to the site, that's not in working condition. For some let's say some equipment may need to be drilled. Let's say a slab to be made there somewhere, right? To be drilled
Yes.
there, to be fixed there. So all those costs that bring the asset to its working condition as intended would also form part of the what? Component of the cost, which is also something obvious. So I'm speaking all this so that after this point, Later, you do not come, you do not use much energy to memorize this because this is the problem. You may find yourself, okay, I have to memorize this and this. No, put it like you are doing it in just the normal course of the business.
Okay.
So that's why you can see the cost of site preparation. Let's say you have transferred the item there, cost of site preparation, initial delivery and handling costs, like the transportation I told you, installation. Let's say you have to fix that, right? Let's say the item is not ready. Maybe you need to test it first. Testing native proceeds on the cell. Sometimes you may be testing an item. By testing, maybe you produce some items which are not ready, but maybe they can be sold somewhere, right? So you can get some revenue. That is not counted as revenue. Deduct what you have earned from that cost, right? And then let's say professional fees. Let's say the architects, the engineers came there. So you just do that. And lastly now, and what? Lastly, initial estimate of the unavoidable cost. Okay, they have written a lot of it. You may start say and say, oh, what am I going to do? When you have the machine, for example, on my side, I also, the same time that I did telecommunications engineering. So, are there telecommunication towers in your country? Telecom towers, right?
Yes.
Yes. Those telecommunication towers, someone may install them and maybe they are given 30 years after which they have to remove them, right? So maybe someone has installed them after 30 years, they need to remove them, right?
Yes.
So you count the cost from the very beginning. I've bought items from certain countries, from China, paid the import duties, reached the item that site, installed it, and done until point C. Now at point B, you are told that, okay, my contract is to use this item maybe for 30 years, after which I'll have to uninstall it, to dismantle it down. So after 30 years, people go there, they start dismantling that telecom tower, right?
Yes.
They take
Yes.
it down, they dig. The foundation for telecommunication towers is usually so deep. So they dig, they clear the land, so it becomes the area becomes like and nothing ever happened there, right? So that cost is also involved. That's why we say initial estimate of the unavoidable cost of dismantling and removing the asset and restoring the site on which it is what located. You get my point. That's what we say the estimate because you cannot be sure of the cost you will incur in 30 years' time to dismantle, right? So
Yes.
you just estimate, okay, in 30 years, I expect to dismantle this, so maybe I expect to incur $10 million. You just take it as an estimate, but that estimate is in 30 years' time. But remember, we are trying to get the cost of our equipment, let's say now, right?
Yes.
So you would also have to get that present value. You see how you see how we cannot avoid it. You start finding it anywhere. Present value, you say future value, the price you expect to pay in the future, you discount it, you divide by 1 plus R power what? Power n, right?
Yes.
So you get used to it, no worry. So that's what you're going to what? And this cost should be unavoidable, of course. If you can avoid it, then you cannot say it is an obligation, right?
Yes.
Yes, you cannot be obliged for something you can avoid. Okay, so those are the four main what components. Very normal. But actually, there are some more explanations here which will actually give us a certain picture, a certain good picture. Okay, we are told here the following costs will not form. So they are just trying to let you know it's normal, but you just need to know them, right? They will not form part of the cost of PPE unless they can be attributed directly. Part C say the costs that are directly attributable. If you see that the cost is obviously directly what? Attributable, that is obvious, right? Yes, it is. But if nothing is said, these costs will not form cost of the what? Of an asset. They're very obvious. Look, administration and the other general overhead costs. These are very obvious. You cannot take administration cost and the other general cost to a particular item, right? But if they are told, they tell you that these costs were specific for bringing that asset to its present location and the condition or to its working condition. Okay, you say it's fine. They have told me, what am I going to do, right? But also, Startup and similar pre-production what? Cost. You know, before production, you may be incurring some cost, maybe the testing, I mean, you may be incurring some startup and similar pre-production what? Cost. Before actually starting to produce, right? You may say, okay, that's no worries. We'll see that. And initial operating losses before an asset reaches its planned what? Performance. You know, you have installed the asset there, you have tested it, you start using it, but you see maybe there are operating losses, and then you say, okay, these are the losses, let me combine it with the cost of the asset. No. If the asset is ready for use, no worries. From that moment, you stop accumulating cost there, right?
Yeah.
Yes. So whenever an asset is ready for use, you stop accumulating the cost. Oh, our time, we have like about 2 minutes. I think after this one, we'll need another one session, and I think you'd be actually. I hope you have obtained something. You have known what to expect now when we do study this, right?
Yes.
Okay.
I have
Now look here. We're told in addition, these are just an addition. Cost of
mhm.
site selection and evaluation are not capitalized. This is I had to bold this because a lot of people make this mistake, right? Cost of site selection and evaluation. There is a point to start accumulating the cost, and there is a point to stop. You need to get that right.
Okay.
Starting point and the stopping what? Stopping
Point.
point. You only start to accumulate the cost, right, of the or concerned with a specific site when you have identified, I'm going to do it here, right? But
Yeah.
before, maybe you're saying that, okay, I'm still trying to look at whether this site should be used or not. Okay, you check it, maybe you incur $2 million, and you say, oh, this site is fine, I may use it. And then you say, okay, I've used the 2 million here. I have to capitalize this to cost of an asset. No, you were yet to make the decision on whether to use that site or not, right? So until you have made your mind on using that site, it's when you have to start accumulating the cost on that what? Site, right?
Fine.
That's what they say. The cost of site selection and evaluation will not be what? Capitalized. The entity will not
Okay.
have had a firm commitment to start developing the asset. Obvious, right?
Okay.
Yes. Now, as I told you, in less than a minute, we are going to